Hello, I'm Blake with Financial Markets Language. Today we're going to be going over what happened as of Wednesday, February 22nd, and we're going to be going over what's coming up next on February 23rd. Today we saw the Dixie go up huge. We saw the Dixie go over to 104.64 approximately at the peak, which was almost 0.75% move, which for the dollar index is definitely a larger move. With this move, you definitely saw commodities in general trending downwards, such as copper, such as aluminum, such as gold, in addition to oil. And obviously that got reflected approximately in the RROB, which is the consumer gas that we buy. Obviously, when it's traded on the stock market, you're looking at the bulk level, but we can't put crude oil into our cars. We need normal gas. As far as the broader market, we had a choppy market today. With the dollar shooting more towards the evening of the market, we saw bond yields in general trend kind of mixed, had a slight down and then a slight up, more or less following the market. But with the dollar big surging into the end of the day, I predicted more of a sell-off just due to the fact that markets were down near the beginning and middle of the day. But with the dollar going up, you actually saw an appreciation of the market, landing today about flat. NASDAQ up a little bit, S&P and Dow down a little bit, but overall, all of them were less than a 0.25% move or a 25 basis point move. So definitely very uneventful, especially compared to yesterday where it was about across the board a broad sell-off. You had the Dow down over 2%, you had the S&P down slightly over 2%, and you had the NASDAQ down approximately 2%. It was kind of like everyone got into each other's head and said, hey, let's just sell 2%. That's what it looked like, at least. The big data that came out today was the FOMC minutes from the last meeting that happened on February 1st. As you probably remember, this was the first meeting that we finally got a downtick in the rate that we were raising rates. For the previous 4 rate hikes, we got 75, but for the very last rate hike, we only got a 25 basis point hike. Definitely showing that the Fed is realizing that we're going in the right direction, and hopefully soon we'll be, around the goal of the 2% inflation target. Take in mind, the last little bit could be, take much longer than more people anticipate, which might lead to rates not declining at the end of the year like the current bond market is predicting, which also means the stock market is predicting it as well. But it's most likely, based on a lot of analyst expectation, going to go down in 2 to 3 years, despite what's currently priced into the market. But obviously, if we saw a much broader decline in the economy, we could easily see rate cuts coming sooner. But I think as of now, the big objective is just to get inflation down a little bit more to at least where we can stop raising. I think that's the big goal, that everyone can finally take a sigh of relief once we're finally done raising. Keeping it high is nowhere close to as bad as going 75 after 75 after 75. There's definitely broad agreement in the market over that. A big data point yesterday that when I didn't make a video that I definitely wanted to go over was the, once again, decline in existing home sales. It came in light. It was expected to be 4.1 million, which is less than the previous month of 4.2 million. Instead, we just got 4.0, dead even, which marked the 12th month of consecutive home sales decline. Me being a real estate agent, I'm just not seeing that as clearly out here, 12 months of decline. But I guess that could also be held true by the fact that now that we're 12 months down from a very hyped cycle, where essentially, back in 2020, 2021, if anyone attempted to sell their house, it was instant success and well over asking. The week supply, which is the total amount of housing available on the market in relation to the amount of buying power that there is in the market, like how many weeks it would take the current buyers to buy the entire market, we were looking at 3 to 4 weeks. We're hovering around that 21. So definitely a nice hop. But with this being said, in the housing market, me being a real estate agent, I'm just not seeing that as clearly here in Gainesville, Florida, where I currently conduct my business. But and in general, that's what the last few data points have been saying. It's been saying that the broader declines in housing volume sales have been occurring in the West Coast and the Northeast, which, take in mind, are also the more expensive markets, which with interest rates, the 30-year, you're looking at 70%, or not 7, I mean, that would be crazy. Luckily, we're not there. We're not going to be there anytime soon. But at 7%, to qualify for these, multi-million dollar homes, you have to have an income that you're talking like, 250K plus just to buy like a $1.5 million home, which, if you look at coastal West Coast cities, that's not really going to get you all that far, that's for sure. So hopefully soon, interest rates will get back down and we'll see a little bit of a price decline, so new home buyers and people looking to upgrade can finally get what they're looking for. As far as tomorrow, what we got on the map, we got the initial joblessness claim, which is predicted to be a little bit higher than it was the previous month. We're predicting 196 or 97,000 jobs people to have declared unemployment, which is a downtick from the previous month, which was 194,000. Take in mind, like, these numbers are irrelevant, especially if you compare them to the January jobs report, where we had the biggest miss since the 1980s on any government report. It was predicted, I can't remember the exact numbers off the top of my head, I can put them here, but I believe it was like 180,000 jobs were expected to be created, and instead we almost got 600,000. Like, we're talking a massive magnitude of new job creation, which obviously will bring an additional wage inflation and just broader inflation for more consumers having more money. But take in mind, a lot of this new job hiring, at least the consensus among analysts, aren't people that are unemployed, getting into the market, because our unemployment rate is already so low and isn't really changing much. It's a lot of people getting second or third jobs just to support themselves, pay their mortgage, other necessities, just due to the rising cost of everything, which is more than understandable. But that won't necessarily have that big of a cause on inflation as compared to someone, for instance, bringing their income from 0 to like 100K. That would cause significantly more inflation, because now, they'd be spending that money not just on, the necessities, but obviously lavish stuff as well. Whereas if you're taking out another job just to cover necessities, I mean, sure, you might have a little bit of a bubble in gas, groceries, and other necessities, but that won't really broadly go throughout the economy the same way as just willy-nilly spending on services and other non-essential items, because that can just cause, more bubbles in just about every sector of the economy. Another data point that isn't as relevant as the joblessness claims, but which also aren't that relevant given how bad the last jobs report was, unless we saw somehow a massive beat, tons more people declaring unemployment that we were predicting, which, I mean, don't get me wrong, it just happened a month ago on the flip side, but that made more logical sense than more people declaring unemployment now than having a job last month, just because you have a new year, people trying to hire, people trying to resituate for the upcoming year, where now you have not a lot of people getting laid off out of nowhere. Like, don't get me wrong, there's been tons of just big tech announced layoffs, and even Ford, I think, recently announced that they were laying off like 5,000 people, but obviously that's just one company, and 5,000 isn't really going to, I mean, it'll make a difference in the report, but it's not going to massively change the report. And I don't even think that report was, like, they weren't going to do it immediately. It was going to be delayed throughout some time, and it wasn't going to be all at once, which is typically how they do them. But in general, small business, medium business aren't trying to fire mass amounts of people just because it's become easier to hire people, but not as easy as historically it has been, which has a lot of people anxious, especially if we go on another inflationary cycle where wages are spiraling out of control. It definitely makes sense to have a good worker base secured right now. So that's why I wouldn't predict this one to be much higher. And even if it was, unless it's significantly higher, it's not going to have that big of an impact. But the next data point that's even more relevant is the GDP. It's the first revision for Q4. As you remember, Q4 GDP came in at 2.9%, which was higher, which is a positive number, meaning not recessionary, as opposed to the last two that were both negative. So good news that, you can't have people making the argument that we're currently in a recession because we just had positive GDP. And the revision is expected to be the exact same. So, I mean, it'd be very unlikely to see the GDP be plus or minus more than 0.1% of what it was originally predicted. And even if it was, that would make virtually no difference on the market. But big things that I am looking at tomorrow is more or less, what is the dollar going to do? What is the 10-year going to do? What is the 2-year going to do? Those are the real big questions, because just in the last 2 days we've had lots of action there. And I predict that bond yields are probably going to continue to go higher as people believe that the Fed will need to continue to hike interest rates in order to get this inflation down. Don't get me wrong, we finally had a slowdown in rates. But as the last few data points have came in a bit more inflationary than people were predicting, we could easily see the Fed get a little bit more hawkish before the end of this cycle. I could easily see the current, the next rate hike go to 50, up from 25, and maybe do that for 1 or 2 times before going back down to 25. I wouldn't say that's the most likely outcome, but I could easily put that at like a 20% chance that would occur. I think personally the most likely outcome would probably just be continuous 25 basis point hikes, probably 2 to 4 more times. And that would probably be the end of the cycle. That would be my current prediction based on what's happening. Take in mind, we did just get some inflationary data from the jobs report, from the wage report, but these are definitely more or less coming to an end. Well, they were coming to an end, and we most likely, according to analyst expectations, will continue to see these coming to an end. So yeah, that's what I'll be watching in the market tomorrow. I hope you guys are all engaged, and I'll see you guys back here tomorrow where we can break down exactly what happened and what moves we're making for tomorrow. Thank you very much. I'll see you guys soon.